Good morning, everybody. It's June 5th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you got any questions or comments, please feel free to drop us a line in the chat area. We'll be sure to get to it during the show. Overnight markets here: July corn up 3 at 441 and 3/4. July soybeans are down 3 1/4 at 1041 and 3/4. And July Chicago wheat was up 2.5 at 545 and 3/4. This morning we had weekly export sales for corn. Say kind of as expected, 942,300 for the old crop, 160,100 for the new crop, which was kind of middle of the estimates there. Soybeans kind of the disappointing side, 194,300 there for old crop. Low end was looking for 100, and new crop very little, 3,500 in sales for new crop soybeans. Wheat. Net cancellations of 49,100 on the old crop. New crop was 444,900, which was just above the lower end of the range there for wheat. Meal 254,700 for old crop, which was also low end of the range. 10,200 for new crop, not real solid there. And on the oil side, 10,300 for old crop and 1,500 for new crop. Good morning, guys. I guess what we know, we're looking at weather here this morning. Not as much noise about this shorter term GFS being dry, but we do see some agreement in the Euro and GFS out forward, more for the kind of western portion of the belt. So something certainly to keep our eye on. As we kind of talked about that a little bit again yesterday. And then this morning, the Chinese media is reporting that President Trump and President Xi did hold a call. The White House has not confirmed that yet this morning. There hasn't been any news from that call, so we'll certainly continue to monitor that situation. Outside markets, Dow rallied once CNBC had put out that headline, so we'll see how that shakes out here this morning. With that, Dustin, why don't you start us off here this morning, share some thoughts, and then we'll throw it around the room.
Yeah, thanks, Dan. I think one of the bigger shakeups that have happened, just because I think a lot of people are looking at the markets and they feel like they've been trading sideways, and they largely have been stuck in a range. We're at the lower end, coming off the lower end of the range for corn. But the July to December spread for corn did collapse here in the last couple of weeks and months. We did go down to a 5-cent carry last night or yesterday on the close, and that was the widest that particular spread from July 25 to Dec 25 has been since October, right? And if you go back, we're not showing that on the chart right now, but if we go back to the October WASD, we were talking about a 2 billion bushel carry out thereabouts. We were looking at above trend line yield. We were kind of the peak of harvest where there's a lot of excitement. And subsequently, what have we had? We've had really strong export demands, especially to Mexico. And we've had some other things, that have come up, like lower yield than expected in the January reports. All of that will carry out decline, yet we're at new lows in the spreads. Right, so I think that's just kind of what happens after we're kind of satisfied for demand for the year, and it really comes down to also who is holding on to the grain. Is the end user, finally kind of having to dump old crop? Is that the reason we're collapsing? So if we want to bring the chart back up, Gavin, this chart is there's 3 lines on this chart. There's a lot of noise here, but the blue line is the July 25 corn contract net change for the 2025 calendar year. So as we go up toward the top end of the chart, we're showing that those are the net gains on the year for that specific date. So we highlight right in that red period there. That blue line shows that we had seen about a 50-cent gain in July corn from December 31 until right there in that early part of Feb. Okay. So the gains were extensive for July 25, and they were very minimal for this green line, which would have been the Dec 26 contract. Those net gains were quite subdued during that same time frame. So we usually see this, the back end of the market, we call it the back of the roller coaster, tends to be a lot less volatile. And if there was some sort of a concern at that time frame, we had peak uncertainty for safrinha crop in Feb. In fact, at that point in time, the weather didn't look that great at one point in time. And that might have been part of that premium is what if Brazil doesn't grow this massive second season crop? As we go through the year, though, I think everyone is pretty confident that Brazil did have a good second season for corn and that we are going to look at a very large crop. So we follow that blue line till today's point, and we're actually, 30 cents lower on the year now for that contract after being 50 cents higher. Okay. But, the reason we're highlighting this chart is look at the green line, which is D26. Look at the orange line, which is D25. Those have held relatively better value. And it could be that, there's a number of reasons for this. I mean, the market has so many calculations it's doing on why. But number one reasons, 95 plus million acres of corn that went in pretty well. And that naturally points acres back towards beans in 2026 and away from corn. So the D26 contract is going to gain value from that. We've been talking about the real like psychopaths, or I have at least for a long time here. It is a very big impact on the back end of the market because there's not a lot of other near-term fundamental news that is going to cause competition. The biggest underlying fundamental way out into the future is going to be currency. For what we know right now. So the back end has been finding a lot of support from that. And we have, the potential for trade deals on the table. We saw the US UK deal. A lot of it was ag focused. We don't know yet what's going to come out with US and India, how it's going to go with US and China. But it does have the feel that the administration is trying to incorporate US ag products as part of those deals. And those things take time. So if that's going to be a positive thing for our markets, maybe hedge funds or maybe managed money is getting along the back end of the market saying that's the safer place to be, and avoid some larger pain that might come from, a slower deal or something that doesn't impact nearby markets as fast.
Justin, interested to hear some thoughts there.
Yeah, there's a lot in this chart and, a lot to talk about. I think a couple things I would just add to what Dustin said, if we overlaid the managed money position too, went from a massive long to a massive short in that same time frame, probably because of a lot of the same reasons that we're talking about, is looking at it from a fundamental perspective, which drives, nearby contracts lower. It makes a lot of sense because once we got the prospective plantings, even though you have a relatively tight carryout in old crop, as you get closer to that new crop supply, you feel more confident that you don't want to hold a bunch of corn at an inverse. You're willing to wait. More end users are willing to wait for cheaper product. So your buying kind of comes down. If people got enough coverage, then you see just not the panic to have to own those old crop bushels as much as when you don't know if you're going to have the new crop supplies or if you're going to have late corn from safrinha, those kinds of things. So I think fundamentally this all makes a lot of sense. And the other thing I would say is as you look at the D26 contract, for example, high interest rates, we know we're below cost of production at current levels. We've already planted the crop. So the fact that we planted a crop below cost of production is irrelevant, right? It is what it is at this point. But as you go for the longer you go below cost of production and when costs are remaining stubbornly high, that does disincentivize, more growers around the world to shift away from corn, for example. So I think, hey, we had this big switch to a ton of corn acres this year. There's going to be a natural rotation, or it's going to be very hard not to have a natural rotation back to beans and other crops. So we do have to have some price, and it's still below cost of production, really at 470. But I think fundamentally these spreads and the curve of all these contracts makes a lot of sense. Like what we do from here obviously can change dramatically. That the key one being weather now. What's U.S. weather? We got it planted. We've put, as we've talked about, we're traded that we're going to have a big U.S. crop. Obviously, it's June 5th. The next 60 days are critical for that. But I think this is a really good history lesson of why we're at these kind of levels. You see the December 25 kind of slowing down as we get into those government support areas with crop insurance, some of those kinds of things. Obviously, the July contract doesn't have that, right? So the July contract can do anything. There is no protection for those bushels, right? So if you have a whole bunch of bushels in the bin, you saw an 80 cent break without, a lot of people having any kind of protection. Whereas, D's 26, for example, or D's 25, for example, had really high levels of crop insurance in a lot of areas, farm bill stuff. So I think this makes a lot of sense up to this point.
Justin, I thought Dustin made an interesting statement about the funds potentially buying out, deferred out forward contracts, based on opinion. I think the general, thought is folks generally think that the funds stay forward. I mean, have you seen in your career, if they do, they'll shift and be out forward to minimize some of that volatility? Or
there's a lot of, yeah. Go ahead.
Oh, sorry, I didn't mean to cut you off there. I wanted to actually make this point before you asked Justin, because we saw this perfectly course. The COT report will segregate fund positions by longs, shorts, but also by old crop and other, which is new crop. All right. So we saw this, that they were actually selling the new crop contracts as they were buying some of the old, right? During the very weak real time period. So I would say once we get through the next COT report, especially after today's move, which isn't going to be till next Friday, that's going to be, or yesterday's move. What did we see yesterday? We saw almost like a rush into D's 26 longs as they're selling out of July 25 positions or selling into them. So to me, that is not just like some random, market action, by a ton of different smaller market participants. That's a few larger participants that are changing positions. And I do think that they're buying the back end of the market. We'll have to wait and get confirmation from the COT report, but that's my guess. So sorry to cut you off, Justin.
No, you're fine. So I think it's important when you talk about managed money, there's a lot of different managed monies, a lot of different types of strategies. So you have ones that are completely technical. You have ones that are completely fundamental. Some are day traders or very short-term traders, momentum traders. There's all sorts of big traders in this. A lot of the reason that they stay in the nearby contract is just liquidity, right? It's hard to go. You couldn't go buy. You could. It wouldn't be pretty, but go buy 100,000 D's 26 corn. There's just not the volume for that, right? So a lot of those really big, some of these guys have positions of 50,000 contracts, right? They're too big to go into those other contracts, so they're forced to be in the front a lot of times. And the way they compensate for that is to also have a spread position. So what's interesting about some of these moves, if you've seen the highest intraday volumes of December 25 versus December 26, yesterday's volume was double the previous day's high volume. You start seeing so you'll see traders that start moving positions, even though they're big to us, they're very small to their overall. So I think it's more of a specialty type of trader that looks at those kinds of things that we're talking about out forward, that puts those in, but they can have a substantial effect on the spreads because they're big relative to the volume that's back there. So even though they're small relative to the overall open interest in corn and even the managed money position, if you get 5% of those fundamental type traders that put those types of positions on, that can really move those spreads. And so Dustin's point, when you saw open interest, really going into selling new crop, back several months ago, I think it was a lot of bull spreaders, right? Because there's a lot of benefits to doing that, meaning that you get a margin discount if you bull spread corn, buy one contract, sell the other versus just outright long or outright short. But so a lot of people will do more size if they have a conviction on the relationship between old and new or new and new. So yeah, there's a lot of different traders, but there certainly are some that are trading that, high interest rate builds carry. And then if you have the acres, I mean, it makes sense. If you have the acres, you have trade uncertainty, then and high interest rates, it generally means good carries. The reason why we were, favorable for bear spreading several months ago on some of these because we had big inverses all the way out. Doesn't make sense in a high interest rate environment if you have the supply. So those shifts in the mentality from, hey, we're going to be way too tight on old crop corn. We sold way too much to Mexico. We're going to be super, super tight. To shift from that mentality to, oh, we've got past that. Now we've got all these acres and they got planted good. Oh my God, we're going to have too much. Right. Mm-hmm. So I think that's the shift we just went on. We'll overshoot that at some point, whether it was yesterday or they take it much further. There'll be some point where we factor in way too much carry, way too much confidence in a massive corn crop. And I would expect some of these spreads to whip around now that we've done this big switch. So
that's really good. That's really good insight, guys, because the fund term gets thrown around so much in our industry, right? It's always the funds, and I think that putting some color on that, guys, was really good. That was good stuff. Rye, we just coming into the open, but explosive day yesterday, and once we got past the rumors on the cattle side, and then the back end of hogs keep trucking. So what do you got for us?
Yeah, looks like still, cash rate picking up here. We're seeing 225 to 228 in the south, 375 for dressed in the north. So, I mean, cash going to be, $5, $6, $7 higher again this week. And the futures are starting to kind of pay a little bit more attention. We're seeing June's up over 220 this morning. So we're starting to narrow that basis a little bit now. I mean, beef market was a little bit mixed, but as of right now, we really haven't seen any real setback here. I mean, you keep on seeing open interest increase. We keep on seeing good volumes. Looking at some of the reports for the CME put volume has just exploded, so I think we're really drawing out a lot of the hedgers here. Just, why wouldn't you at this point? We're right near record highs. So kind of an inside day. It looked like we've been kind of consolidating. So we still need to get back and test those highs that we saw since that last big reversal. But we are knocking on the door of that. So I think overall, there just really isn't any too much bad news that the market's really going to pay attention to on this week's weekly export report. Net sales of 9,000 metric tons. I mean, this is down sharply. So it does kind of feel like we're hitting a point price-wise where we're going to start turning exports, on the weaker side of things, just probably from a pricing standpoint. But like I said, no indication of a top in cash yet. I think everybody's still wondering what's going to happen here down the road. Seems like all the confidence is still really in the front end of the market on the cattle side. So we're just trading week to week cash at this point, and just keeping the focus really on the beef to see if there's any kind of real turnaround here seasonally. On the hog side of things, does seem like we've had that bit of a roll going on between June, July, and August. That July-August spread just completely tanked yesterday. Almost $3 move in that spread just in the past 4 or 5 days alone. So it's been it just seems like we're really keeping that confidence that either supplies are going to be tight here in August, or we're going to have pretty firm demand in general, and that maybe expansion could be a problem. Obviously we'll be kind of following the data as it comes, but I think that's the perception right now. It could just be that one-off kind of roll right now as well. But we'll kind of see how that pans out. Exports this week were 36,400 metric tons. So, relatively firm here. China's back here, 12,700 metric tons for China alone. So I think that's going to keep this confidence here for right now, unless there is some big kind of new geopolitical shakeup, depending on what was said on that call today between Trump and Xi, and it's something that the market's likely to pay attention to. But overall, the cash market was up $4 on the hog side of things, and cutouts holding up pretty well here. So, all the news is still pretty friendly here.
Very good. Appreciate the update. Just came into the open. We got July corn up to at 440 3/4 as the last. July soybeans are down a quarter at 1044 3/4. And July Chicago wheat's up 4 1/4 at 547 1/2. A couple things to point out. Tomorrow morning we'll get non-farm payroll, so that'll be out usually around 7:30 or so. We'll take a look there. Outside markets will be focused heavily on that number. Also, Fun Fact Friday, everybody's favorite time of the week. Never know what Brian's going to bring, so be sure to tune in for that. We appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and certainly subscribe. It'll keep you up to speed on everything that's going on with AgYield. And again, thanks to everybody that supports the show. We're doing this live every day that the markets are open on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. Hope everybody has a great day, and we'll talk to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.